All attendees are in listen-only mode.
Hi, good afternoon. This is Benjamin Levine, Chief Investment Officer for 3D Asset Management. Welcome to the second quarter 2017 market commentary. Just some quick housekeeping items. This broadcast will be recorded, so a recording will be made available on the advisor portal of our website. And also at 3:45, we will be hosting the portfolio review for contracted advisors. Again, we'll be recording that session if you're not able to attend. If you've not received an invitation for that, please feel free to reach out to your 3D contact and we'll get you a link shortly. And finally, if you have any questions, there's a chat box on your screen and you can just type in some questions and then we'll make sure to get to them at the end of the broadcast. So some quick disclosures. So the quarter was interesting in the sense that it was largely a continuation of what we saw in the first quarter, namely that doubts have started to surface over whether we're seeing the end of the so-called cyclical trade momentum that began in the fourth quarter, as well as doubts over whether the Trump administration will be able to push through some of its policy initiatives, namely tax reform, healthcare reform, infrastructure spending. Oil prices, the U.S. dollar, bond yields all dropped in the quarter, kind of reflecting this new angst. The conflicting signals seen in equity, bond, and volatility markets imply that we are reaching an inflection point on the macro development front. All seem to point to a slowdown, but in varying degrees, as very few see an inflationary-led cyclical growth spurt at this juncture. Despite the peripatetic shift in forward growth expectations, U.S. consensus for 2017 GDP growth has remained at around 2.2, 2.3% over the last 2 years. The Federal Reserve of Atlanta's GDP Now model is forecasting 2.7% annualized growth for the second quarter, and this is as of month end. But this has steadily declined from the beginning of April. Yet global markets have advanced higher while credit risk remains benign. If we're not sliding towards another recession, then the markets are at least signaling an environment of low but scarce growth characterized by a search for yield while avoiding anything remotely cyclical such as commodities. Yet the Federal Reserve has reaffirmed its commitment to its rate tightening schedule, so far 3 in 2017, as it seeks to normalize monetary policy by raising rates and reducing its balance sheet. Fed official comments look towards a recovery in inflation as the recent drops have been driven by lower energy prices as well as one-off items such as mobile data plans. The so-called U.S.-driven cyclical trade, which is small cap risk, value risk, and the strong dollar, had represented the consensus trade at the beginning of the year, but the consensus trade has now shifted to a preference for low volatility and growth momentum as well as for overseas investments as reflected by the weakness in the dollar. This shift has just begun and will likely continue until the market sees further catalysts to resume cyclical economic growth. Wanted to revisit some of the key questions that were brought up at the end of the first quarter. It's this notion that we've been speaking about really since the beginning of the year about these tectonic forces of cyclical reflation combating secular disinflation. And the big question is are we renormalizing the new normal, or as the new normal conditions prevail? The new normal, just as a reminder, was coined by Bill Gross and Mohammed El-Arian, formerly of PIMCO, in 2009, that the new normal characterizes the post-2008 macro environment as one suffering from the secular deflationary forces of aging demographics, high debt levels, and excess global capacity. So the first question we asked at the end of the quarter was, can the incoming U.S. administration reverse the new normal overhang on U.S. business production, and how will such a reversal manifest itself? Well, so far, all we're seeing are delays and potential failures to enact many of these initiatives, such as healthcare and tax reform and infrastructure spending. So the jury remains to be seen as to what kind of impact it will have because we've yet to see any progress movement in these initiatives. Another question we asked is, will a new round of inflation be unleashed as the new administration seeks to roll back government policies regulating large swaths of the industrial sector, freeing up pent-up growth, but also unleashing demand that could push up prices? So far, apart from housing, we are starting to see a stall in consumer and capital spending, although capital spending intentions remain quite robust. Manufacturing sentiment has actually started to decline. Lower bond yields and a flatter yield curve also signal sluggish longer-term economic growth and lower inflation conditions. Yet financial conditions remain loose and corporate earnings growth is still robust. So as far as the financial sector is concerned, there is little in any way of overhang, and the conditions for earnings growth continue to be strong. And then finally, will the Fed's goal to normalize monetary policy and preempt cyclical inflationary pressures by pursuing a more aggressive rate hike policy help subdue any macro credit bubbles that could form during a cyclical recovery? So some Fed officials have expressed concern over the subdued market volatility that we've seen in the marketplace, as well as high equity valuations. However, outside of China, few credit bubbles have emerged. So far, Federal Reserve officials can point to very few areas within the global economy or the global market where they're seeing credit bubbles start to form. As I said earlier, first, the overall quarter was particularly strong for global equities, especially overseas. International and emerging markets outperformed with roughly 6% compared to the 3% for the S&P 500. Valuations do remain a little stretched as far as the S&P is concerned, and they're starting to creep up for the broader markets. Global equity markets turned in a positive quarter despite weakening towards the end of June. Ex-U.S. markets led the U.S. market as global macro conditions continued to improve despite efforts by China to crack down on systemic risk within its financial system. Such crackdowns in the past have resulted in a flight in capital reserves and typically a global-led sell-off. The U.S. dollar also weakened in the quarter and is now trading at levels prior to the November election. The U.S. dollar is down 3.5% for the quarter and down 6.5% for 2017, which helps explain a good portion of the outperformance of ex-U.S. markets versus the U.S. On the fixed income side, despite a rate spike that we saw at the end of the quarter, fixed income put in a relatively decent quarter, again led by high yield, which has been leading the markets for just over a year now. Global fixed income had been benefiting from flattening yield curves and lower volatility before being surprised by hawkish comments from the European and Canadian central banks that resulted in a rise in global yields. The 10-year U.S. Treasury yield had dropped to, at one point, 2.14% before spiking to 2.3% at quarter end. The 10-year German Bund yield rose to 0.47% from a low of 0.25%, and the French 10-year yield rose to 0.82% from a low of 0.6%. One of the other big stories of the quarter was oil prices crashing into another bear market before recovering at the end of the quarter. U.S. NYMEX spot oil dropped to $43 a barrel from $50 a barrel at the beginning of the quarter before recovering to $46 a barrel at quarter end. Energy investors were surprised by the surge in U.S. production as U.S. producers took advantage of the recovery in oil prices from earlier in the year. And as we'll see in a minute, a lot of this surge came from the fact that U.S. producers have been able to lower their drilling costs down to where current oil prices are residing. This was another tough quarter for small cap and value, which lagged again in the second quarter, although made up a little bit of ground towards the end of the quarter. The gap did narrow in the last week of the year following the rise in rates, and we saw technology give up its leadership to healthcare over healthcare reform prospects, as well as to industrials and financials. However, energy and telecom were down sharply for the quarter. So far, large cap growth style of investing remains in favor, at least within the U.S. Prior to the last week of the quarter, it appeared the narrative has settled into a calm, defensive market characterized by low volatility and lower rates. But then the final week saw the U.S. dollar weaken and global bond yields rise over hawkish central bank comments, particularly from the ECB. The global bond market sell-off began with hawkish comments from European Central Bank President Mario Draghi, who mentioned in a speech that the ECB is preparing to reduce its monetary stimulus later in the year. The comment surprised investors as the euro rapidly rose against major currencies and global bond yields rose as fixed income investors interpreted Draghi's comments as a sign that global economic conditions have improved to warrant removing emergency monetary pressure measures such as quantitative easing. The Federal Reserve appears to be committed towards one more rate hike this year for a total of three in 2017, despite the flattening of U.S. yield curve and lower inflation expectations that are priced into tips. One could argue that since Federal Reserve Chair Janet Yellen and ECB President Mario Draghi are approaching the end of their terms, the tradition for central bank leadership transition is to ensure that the successor is handed a more normalized policy regime from their predecessors. In addition, the lack of wage growth has enabled the Federal Reserve to pursue data-dependent policies that will help ensure that they remain behind the curve should inflation eventually pick up. The bond market does expect lower inflation, at least as relative to what it was expecting at the beginning of the year. The break-even yield remains below 2% despite the late quarter spike up in yields. And inflationary trends remain subdued. And in typical fashion, what we typically see in sell-offs like this is that buyers will step in, take advantage of higher yields because they do anticipate that inflation for the near term is going to remain under pressure. The U.S. dollar continued its year-to-date weakness against major currencies as the world started to catch up to the normalized rate path communicated by the U.S. Federal Reserve from last year. U.S. dollar is now trading at similar levels prior to the November election. As we mentioned earlier, it's down 3.5% for the quarter and 6.5% for the year. Europe had led all regions, and it was particularly driven following the success of the French elections, where the centrist candidate Emmanuel Macron had prevailed, and Macron campaigned as the reform candidate. So the hope is that Europe is starting to embark upon a normalized path, and that populism is starting to wane within Europe, and you're certainly starting to see that in the polls. Emerging markets also led in the quarter, as did the broader Pacific region. The S&P did lag all other regions. In terms of factor performance, this was another strong quarter for momentum, pushing its year-to-date leadership above all the other factors. It did give a little bit of leadership towards the end of the quarter, but again, overall, momentum continues to be the standout performer versus all the other major factors. With the dramatic drop in the 10-year Treasury yield and this quarter's outperformance of defensive over cyclical sectors, we find ourselves debating whether the so-called low volatility trade looks overcrowded, and that's the red line. You can see that low volatility as a style had been performing well, but then gave up a little bit of its leadership because of the rise in interest rates. Although momentum strategies have turned in strong performance this quarter, the rally in low volatility stocks could now just be picking up steam. Of course, an upward move in inflation would arrest this shift towards lower volatility, as well as the long-duration fixed income risk. But mobile data plans aside, it is difficult to pinpoint inflationary pressures given this year's drop in commodity prices. Market expectations for long-term inflation now remain comfortably below 2% despite an economy near full employment. A flattening yield curve also suggests that investors doubt Federal Reserve officials' forecasts on renewed inflationary pressures. And you can see that in the 2 to 10-year term structure. That's flattened quite a bit so far this year. It's in the 2 to 10-year yield curve is also flattening in reaction to perceived policy administration failures, as well as what they perceive to be weakening macro conditions. Wasn't the 10-year Treasury supposed to spike to 3% on the heels of a hotter economy brought on by fiscal stimulus? Recall from what we observed at the beginning of the year. Hedging interest rate risk may be tempting in a reflationary environment, but much of the losses have already been incurred in the fourth quarter. And shorting treasuries at that time felt like a crowded trade, not to mention that hedging interest rate risk is akin to buying insurance after the catastrophe had already hit. Right now, the market remains comfortably long treasury positions, which one could argue is merely a reflection of the extreme on the other side from what we saw at the beginning of the year. But for the matter at least, the bond market seems to be signaling a slowdown. What to make of the oil sell-off? Is it a matter of too much supply, or is it a matter of weak demand? Oil prices accelerated a sell-off that began in the first quarter, with NYMEX spot prices having dropped from a 2017 peak of $54 a barrel to a low of $43 a barrel, before recovering to $46 a barrel at quarter end. However, this time we see that energy demand is not falling off a cliff, but continues to grow year over year. The major oil price collapse from the third quarter of 2014 to first quarter of 2016 occurred in a backdrop where China's energy demand had actually declined during the first half of 2014, according to the International Energy Agency. China's apparent oil demand, though, has risen this year, according to S&P Platts, suggesting that the backdrop for energy, although slower in prior cycles, is not decelerating to a degree that suggests a major supply-demand imbalance is developing like the one seen in 2014. In addition, we note that really it's the U.S. that has driven the supply issue. The rest of the world has actually cut back on their oil production. Global X Funds notes how global oil production has fallen this year, with the U.S. being the only region to show positive production versus the rest of the world. Nonetheless, energy investors were surprised to see how quick U.S. production came back online as break-even costs continue to drop. According to Global X, break-even now is estimated at $35 to $40 a barrel, which is a 55% drop from the 2013 levels. What are the main contributors to the drop in break-even prices that have caught investors by surprise? Global X lists three likely catalysts: technological advances such as using big data, 3D imaging techniques, and advanced materials in drilling and pumps. Drillers have also been able to renegotiate lower oil field service costs, and they're focusing on their most productive wells, or what's called high grading, or employing the most efficient existing wells rather than drilling for new ones. For now, North America, rather than OPEC, remains the new price setters and has limited the effectiveness of OPEC in curtailing its production to support prices. Despite the weakness that we saw in commodity prices, which had precipitated the sell-off in high yield from 2015-16, credit spreads remained stable. We did see a pickup in energy-related spreads. If you look at the bottom chart, the black dotted line tracks the high-yield energy spread, but for the most part, credit spreads remain benign. So unlike what we've seen in prior episodes where the market starts to turn into a deflationary, risk-averse mindset, you're not seeing that spill over into the credit markets. Valuations still imply about 5 to 7% long-term returns for equities, and this is just back of the envelope estimate where you take the forward price earnings estimates of the three major markets, you invert them into earnings yields, and you get roughly 5 to 7%. Looking at the earnings situation within the U.S., according to FactSet Earnings Insight, second quarter earnings are expected to grow 6.6%, which is down from the 8.7% growth forecast at the beginning of the year, but the downward driven had been mainly driven by the energy sector. For all of 2017, analysts expect earnings growth of 9.8% on top of revenue growth of 5.1% for the S&P 500. Short of a global disruption, such as China cracking down on systemic enterprise risk, global financial assets should continue to be priced at a premium, whether equities in the form of high price earnings multiples or credit in the form of low credit spreads. If energy prices stabilize at current levels and some progress is made in D.C. concerning healthcare and tax reform, then the focus should shift back to earnings in terms of how they're going to track for the end of the year. And with that, I will go ahead and open it up to any questions. So one question, the audience might contemplate is as we head into 2017, what are some of the key risks or key issues that we're going to be wanting to pay attention to apart from how earnings are progressing? Obviously, DC is going to remain in the spotlight. We see that the market can certainly move intraday as well as day-to-day based on any headlines that might come out. But also, a lot of attention is going to be made to Fed officials in terms of forward-looking comments concerning monetary policy. We just saw yesterday the market rally on Janet Yellen's comments about which was perceived to be taking more of a dovish stance in terms of the pace of rate tightening. And then also want to pay attention to any other efforts that China may take on cracking down systemic enterprise risk. And but other than that, very few kind of things can be sort of forecast in terms of what might cause market moving events. And we could just very well see an extension of what we saw throughout the first half, which is kind of a low volatility type of environment. So with that, we'll go ahead and conclude our market commentary. Again, thank you for participating. And if a recording of this commentary will be made available on our website. Thank you again for listening in, and we look forward to keeping you up to date throughout the rest of the year.